But at the end of the day, for the smaller businesses, and I mean, to be clear, 45 million is a small business. That is still a small business. Your levers to make or break your financial performance are not about capital management, really. They're about accountability and efficiencies and making the right choices on where to invest your resources for growth. That's what it's about. So you can't really do that just in a finance silo. You have to consider all these other things too.
Welcome, Kicking Ass and Taking Names, the Business Owners Empowerment Podcast. I'm your host, Marlon Griffith Esquire. Join us on this podcast journey as we help you break free from the grind and get your business to work for you. We will delve into impactful conversation with business owners, corporate leaders, professional service providers, and industry innovators that will provide you with insights and actionable strategies that will transform your entrepreneurial path, boost your success, and put you in control of your business journey so you can kick ass and take names.
Welcome to my next guest, Nicole Sithithavorn.
Yeah.
Thank you so much, Nicole, for joining us on our next episode of Kicking Ass and Taking Names. I'm going to get right into it, right?
Yeah.
You were the first in your family to go to college, working two jobs to stay there.
Yes.
Did CFO of a $45 million company even feel like an option back then?
No. I would say that I don't feel like when I was growing up, there wasn't a lot of professional expectations for me. So no, I don't think so. And also when I went to school, I wanted to be a journalist. So it was...
That's the furthest away from numbers.
Things didn't turn out exactly the way I thought.
Right.
No. Yeah.
Right. Right.
But...
So you had, and this is what you posted on your LinkedIn.
Mm-hmm.
So this is not new to your surprise. But you said you had a chance compensation at a deli that changed the direction of your life. What did that guy say that got you into his construction company?
So I was still in school and I was working a horrible admin job in a building. And a friend of mine and I went to the deli in the building next door to get a Diet Coke. And the man behind us in line owned a construction company. And so, he just talked to me and he asked me if I wanted to come in for an interview with him. And I have no idea why he hired me, to be honest. I mean, he hired me to help finish the implementation of a CRM system that had been partially completed by someone else who left. Mm-hmm. And I mean, I was in school for communications. I really didn't have any qualifications for this, but he apparently saw something in me and probably I was a pretty cheap hire. So changed the direction of my life because I worked in that industry for such a long time.
That's right. That's right. One chance hire, one chance opportunity, and it's basically set the path of your entire professional life.
Who knows what would have happened without it, right? I don't know.
Exactly.
Yeah.
So you joined the home improvement company as an assistant, a controller. Then you left for a stint as a VC for a VC firm. Then you came back to that same company with a shot to buy it. What made you come back?
What made me come back? I mean, it was a good opportunity. And I had worked there for a few years before I left for the VC firm. And I just didn't really see the upward trajectory available to me there before.
As an employee,
which was, I'd say the primary reason why I decided to make that move. At that time, that wasn't the same home improvement company as the Deli person, to be clear.
Sure.
But at that time, I was in grad school and pursuing, my CPA and the education requirements in order to do that and everything. So it just seemed like a good opportunity. And it was a decent enough minority share to be meaningful. And I felt comfortable for the most part with the two people that were already partners there that I was going to be partnered with. And then also in the VC firm I was in, it was an easy job. And, sometimes that's not good, right? Sometimes it's not stimulating. It wasn't stimulating enough for me. Way that even though it was interesting to a degree and there were lots of different kinds of companies and I got exposed to a lot of different things, I just didn't really feel like there was as much immediate potential there. So
okay. Okay.
Mm-hmm.
It wasn't stimulating to you. You worked at a home improvement company for a few years, then you left. You came back because there was now an opportunity to be a minority owner.
Yes.
Right? So
Mm-hmm.
what was it that caused you to say, you know what, I can be an owner of something. I no longer want to be an employee. I'm ready to be an owner.
I have a good amount of personal confidence, I guess. So I think that might have had something to do with it. But
Sure.
I mean, it was an opportunity to sort of leapfrog my way up because I was going from assistant controller and then I went to an assistant controller role at the VC firm. And then I was leapfrogging the controller role into the CFO, COO role, which was good. And I mean, at that point, I feel like when I was there initially, I was kind of doing some of that role, actually, even if I wasn't called controller or called CFO. And, I had a good amount of experience and I felt like I knew how the business worked because I had worked in a lot of different parts of the business and I had understood a lot of different parts of the business too. And so it seemed like a good way for me to position myself as a leader there.
Sure. So you grew the company under your leadership. You grew the company to $45 million with zero debt.
We
How
did.
the hell
Yeah.
did you do that?
Very responsibly.
And how long did this take, by the way?
Well, it was probably in the low 20s at that time. And then within 4 to 6 years, we were doing the 45. And then the following year, we also grew. And I think the last year I was there for a full year we did around 58 million of revenue. So, I mean, the main thing about that though is of course planning, right? Planning out how you're going to go about achieving this growth and making sure that there are pretty hard lines around accountability and metrics and making sure that people really understand how their operational choices are impacting the financial performance and the liquidity of the company. Because if you aren't real intentional about that, then you find yourself in these situations where you have companies where they sort of grew themselves out of business, right? Or the owners of the company have to take sort of immense personal financial risk to fund the growth, and they are more right tolerant of that risk, right? That's a very personal thing. So, I mean, we didn't have a huge line of credit. I mean, it's very challenging for smaller businesses to get large lines of credit and without, pledging personal property and all of that. So I think we didn't really feel like we had much of a choice but to do that. But when you're prioritizing accountability and margin performance and responsible budgeting, I think it's possible. And frankly, sometimes there's just a trade-off where you can't reach a higher growth trajectory because of the risk that might be involved with obtaining it.
So let's see if we can break this down into layman's terminology, right? Because you are a licensed CPA. But I want to get into, if I can, as much as you're willing to get into, kind of the details of how you operated that company from the finance perspective.
Okay.
To basically be able to grow with little or no debt. I mean, obviously, pretty much no debt. What decisions did you make?
Well, that's a pretty broad question.
Well, let me ask a more specific question then. Just give me 3 decisions that you made in that process that you believe is what led to able to grow the company, be profitable, and not have any debt.
Well, I'll answer it for that company, but also in a more broad context, because it's really common for small companies to have to grow without accessing debt.
Capital.
Not much debt anyway. I mean, beyond, using their credit card for this or that, or having some amount of accounts payable to vendors, a lot of times they don't have access to the kind of funding that, these bigger institutional kinds of companies do have access to, right? So the way that functions with growth is all about understanding how different parts of the company need to work together in a sustainable way. I mean, it really comes down to that, right? You have to set up your company so that things like the front end, customer acquisition, whatever that means for you, that budget, the pricing structure, the way you go about achieving sales in your business, the way you go about delivering it, the compensation structure you have for all of these different people, and the way that you're running, sort of the back office admin aspect of your business, all of those things are connected. And so when you see the need for a lot of debt, or people get in trouble actually with it, it's often because they think of these things in sort of a silo. What I spend on my marketing budget is not necessarily related to what I pay to my operations staff to deliver efficiently. It is related. And that's related to your pricing structure. And that's related to how you hold people accountable on your team and what your expectations are of those people. All of these things are related. So if you approach it in that kind of a manner, it makes it much easier for you to understand how a certain pathway to growth may or may not be achievable right now. And usually if it's not achievable, it is because of a liquidity question. It is not because you couldn't possibly get that many more opportunities or you couldn't possibly hire that many more people. Now, some businesses, different businesses have different levers. Some businesses have less control over their pricing than other businesses do. Some businesses, it's much harder to access the opportunities, or it might be much less controllable in price. Other businesses, there's, almost unlimited market potential, right? So these are all pretty personal to each business in each market. And it also comes into play when they're trying to expand into a different market, whether that market is a new geography, whether that market is a new type of service they're offering, or just offering the same thing to a different kind of customer. You really do have to think about it as one system. And we do see people getting into trouble. Like, for example, if you have a service-based business, this is often something that happens. They're participating as an employee in a service-based business. They leave, they start their own business that does that thing. They're doing great, right? They get opportunities, they sell it, they deliver it. It's great. They're making money. Then they have this struggle because they're hiring more people to do it. They're making their business more complex. They're not maybe adjusting the pricing structure to account for the cost of that complexity. They're not adjusting the way that they go to market. They're not adjusting the way that they sell. And the next thing you know, they are having a really hard time with their cash flow, right? And then they have to make really hard choices about, am I going to tap my, home equity to fund this, and those are the kinds of risks that we want to try to help our clients avoid, right? But the fact is, it's that simple. You got to think about your business as an entire ecosystem and not as individual silos.
So you have to be aware of what's happening, know what's happening, and what each area costs and what it's producing as it relates to the overall business.
And expectations of efficiency are really important. People have ideas. They have ideas about efficiencies in their business, about how things happen, about how they convert their cash flow. They have a lot of assumptions that are often not true, and they don't collect the data well enough to be able to validate their assumptions, and it's harmful, right? So, data improvement is a big part of it too, making sure you're capturing the data that you need to be able to understand how these silos of your bit function together and where you're having efficiency leakage.
Right.
I mean, this really is all finance. Of course, I think everything is a finance topic for business, right? But at the end of the day, for the smaller businesses, and I mean, to be clear, 45 million is a small business. That is still a small business. Your levers to make or break your financial performance are not about capital management, really. They're about accountability and efficiencies and making the right choices on where to invest your resources for growth. That's what it's about. So you can't really do that just in a finance silo. You have to consider all these other things too.
Right. So you've served in both roles as a CFO and a COO, right? And
Yes.
I think you kind of mentioned that a little bit earlier. What did having both roles, both of those seats, what did you see that you may have missed if you only had one of those roles?
Probably that whole idea of why this ecosystem matters. But I think the main thing is the people, right? The people and the staffing of the business are incredibly important to its ability to be effective financially, right? So that means, how are they managed? How are your managers managing people? How are they holding them accountable? How are you communicating to them whether or not they are being successful at the role? Do they know? Do you have conflicting scopes with different people? Do people really understand what is and is not their responsibility? Because that's often the start. And people are surprised sometimes when we ask them to review the job descriptions of their operations staff or whatever kinds of staff. They totally expect it for finance, but financials are the result of everything that happens in your business,
Not the
right?
cause.
So I do think that bridging that gap, operationally, and then helping the other people on the management team that are non-financial managers actually understand how their impact really matters is pretty important. And I think that probably that came more from the COO parts of what I have done in my career.
So obviously, as a CEO, most likely, the CEO does not have the experience and the type of knowledge that you have as a CFO or a COO.
Yeah.
Most likely,
Right.
you own your business, you're running your business.
Mm-hmm.
But he's working or she's working with you and your company.
Mm-hmm.
What should the CEO be expecting from you, and what should the CEO be looking to review from you? And how should the CEO be interpreting what they receive from you?
So
Trifecta.
yeah, we have to teach people how to work with us because the expectation is that we're going to show up twice a month and talk about financial performance with them,
Right.
right? Or talk about cash flow. That's what the expectation is. And we are going to do that, to be clear. That is going to happen. But that is not the only thing that's going to happen. And so we are proactive around bringing ideas and strategies to improve things to our clients. And I think that the proactive versus reactive approach is really important. But it has happened certainly that people make really significant choices without realizing how significant they are. So we tell people when they get started, sort of err on the side of caution and bring it to us, right? Bring it to us. So if you are thinking of, selling a new product, obviously we need to know about that, right? If we are going to talk about hiring a new significant person in the business, we want to talk about that too. We want to understand what is their job? How can we compensate them? How can we use some performance-based comp model to make them effective? How can we get data from it? If you're changing your HRIS, if you're changing your CRM, if you're doing any of these things, we want to be involved in those decisions because, a full-time CFO would be involved in those decisions, right? They have to be.
Right.
All of those things, of course, they do impact the budget around, how much do these actually cost, right? But they impact the future trajectory of the business, right? And so, we're involved in a lot of decisions for our clients, right? Well beyond the expected like finance SOPs, vetting vendors. We sometimes participate in interviews for significant operations hires or marketing hires or sales hires. We kind of work as a strategic partner. I think that is a little bit higher than what people expect from a CFO. But in reality, this is the job of the modern CFO. It's just that people just don't know that because they haven't had one before. So
Sure.
Mhm.
You're very integrated in the companies, and you're proactive CFO as opposed to reactive. Here's what the month before says. This is the numbers from the month before. Let me explain it. That's reactive as
Yep.
opposed to
Right.
being proactive. What are you trying to do? What's your plan? Let's say we work through that, and you offer advice and suggestions in a way to make it in a way where that company could maybe able to grow with zero debt.
Yeah. Well,
Eventually.
when you're thinking about how to grow, your number one question is like, what is the restriction on the capacity of this company? Because they're not the same. Sometimes there's lots of different reasons that the capacity of the company is restricted, and you need to understand that and be able to clear that hurdle. So sometimes for us, that's, we need new leadership literally on the front end of the business. How do we get opportunities? How do we close deals? Right? That's the clear one, right? Sometimes it's staffing. Sometimes it's retention of staff problems. Sometimes it's a combination of those things. Those are all real financial issues in the business, right?
Sure.
People don't think of that as financial, but it is financial. And and other things that are impacting the value, like high customer concentration or too much dependency on the owner personally for critical functions, all of that kind of stuff. But these are not like short fixes. They don't get fixed in a day. They have to be kind of targeted and addressed over time.
So one of the things, Nicole, that's unique about your experience as a fractional CFO is that you've actually, what we've been talking about, actually ran a business, the home
Mm-hmm.
improvement business. But as importantly, you sold the business.
Mm-hmm.
In 2021, you sold a business. So
Yes.
what did that process teach you about what actually makes a business valuable to a buyer?
Oh gosh, that's pretty complicated. I mean, it taught me a lot, obviously, right? And, since then we've had more experiences. We do help our clients get through sales. We're not brokers, we're not investment bankers, but we are their CFO. And the CFO's job in that environment is to help communicate what the situation is at this business, what makes it valuable, what are the relevant factors in this business that might come up for any kind of buyer. Of course, there's lots of different kinds of buyers. So because of that, it can be complicated about what really matters. But at the end of the day, what matters is the future potential of that business. So things
Right.
that harm the future potential of that business make it, obviously low margin is the clear winner on that, right? Low margin is making it less valuable. But so are things like compliance risks. So are like high staff turnover. So are things like customer concentration, or, the owner's the only one that can do these 6 tasks in the business. So, we work with companies that are more or less close to a potential sale, right? And we don't specifically engage with people for the purpose of selling their company or to prep it for sale. But all of the things that we engage with them on are for the purpose of growing the value of that company. We want to make it run better. We want to make it more valuable to the owner. We want to make it more enjoyable for them to own. And usually the things that make those things true are also the same things that make the business more valuable to different potential buyers. I mean, certainly you want to make your business worthwhile to more than one kind of buyer, because if you don't, you'll probably never sell it.
Right. So tell me, but what exactly specifically? Because one of the things, talked about in the past, and not with you, but in other podcasts, is, what a buyer's looking for is, do you have, systems and procedures in place? So that the company's not relying upon, as you said, relying upon the owner to do certain things. But what else? I mean, what else would make a business attractive? I mean, what made your business attractive? Maybe we can start specifically with you. What made your business attractive to the company who ultimately bought it from you?
I mean, so obviously high EBITDA rate makes you attractive, and also dollars. Obviously it does. But effectiveness is what makes it attractive. You want to be able to demonstrate that you and your management team, and don't discount the management team aspect of this, right? That's really important. Have the ability to make intentional choices about how to grow that business, and that then you can effectively implement them. And also, you also need to identify areas where the plan's not working perfect and be able to regroup. So that's one of the things that we talk about with forecasting, right? Forecasting is valuable for more than one reason. You do this forecasting exercise for years and years, and you can communicate to a potential buyer in the future, we decided to do this strategic initiative. This was the results. This is how we pivoted. This is how we made it work, or it didn't work. That's just the name of the game, because at the end of the day, they want to look at what you have done successfully and figure out how they can do it exponentially more successfully.
Right.
That's why they're willing to pay, 5x or 8x, right? And the other thing is, I mean, there's certain easy things people can do. I know people like to save money on taxes and everything, but it's really not worth compromising the value of your business to be doing a lot of, commingling of funds. We do see people cutting corners on compliance a lot that I think are very counterproductive to them. They don't understand why that's true. Don't neglect to buy, cyber insurance because you don't think that you're going to be a target of a hacker. Just get the insurance. So that way, when somebody goes to look at your business in the future, they don't see like a huge risk red flag. Do the contract review. I mean, make sure it's legal. Be careful when you're offering warranties that you are intentional about it and you're not setting up some, permanent future potential liability, because all of these things are going to impact, yes, your ability to sell, yes, the price, and also the deal structure, which can have, pretty big personal implications to the owner for many reasons. So these are all pretty complex things. And like you said, people, they start businesses, they know their business, right? They know their trade, they know their product. I don't, we can help them with this kind of stuff, the compliance, the finance, understanding operationally what makes it more or less valuable, doing certain strategic initiatives that drive margin. We can do all that stuff. I can't put in an HVAC unit, I
Right.
can't
Right.
do digital marketing. I can't do any of that stuff that they can do. I mean, that has to be done first, or there's nothing to make more valuable, right? So I think that we just have this understanding that, everybody on this team has a valuable perspective, and we all have to work together from our perspectives to make it better, right?
Yeah.
I mean,
Well,
cash
one
flow
of
forecasting, of course, important too. The rate at which you are able to convert your profits to cash, really important, because at the end of the day, the buyer is probably going to get some loan to buy your business. And if they can't prove to the bank that they can pay the debt, they're not going to get the loan and your business isn't going to sell, right?
right.
Nobody wants to buy a business that can't cash flow enough to cover its own debt.
Right.
So,
Right. Right.
yeah.
So,
Yeah.
it's a term that you use very often. You said it's grown on purpose and grown by accident. What's the difference between those two?
So very often businesses just grow kind of by default, right? It just somehow happens. Sometimes, you can see it too where it's been a very long time, 20 years, 30 years. And over time, it just does happen that it grows, right? It might not grow as rapidly as another business does. It has some strong growth, and I would say, that's kind of growing by accident, right? You're not really going into your next year and saying, okay, how am I going to go about achieving this goal granularly? Not just, gee, I'd really like my sales to be 20% more next year. Like lots of people do that, right? But how do I make that happen? If I'm successful, what is it going to do to my bottom line? What's it going to do to my cash flow? Literally, what initiatives am I going to have to do to be successful? What people do I have to add to my team to handle that volume? That's the difference, right? Between growing accidentally and growing intentionally. Growing intentionally, you are saying, these are the different kinds of things I do in my business. This is the value each one creates and how we approach those different, we call them segments, differently. And I should invest my very limited resources, which is essentially time and money all the time, into this particular initiative because this particular initiative is the most accessible or the most valuable for whatever reason today. That's
Okay.
intention, right? So it
Makes
can be a
sense.
commitment, of course, too, right? Like people, it can be hard to do that.
So you also said that when cash gets tight, companies often pull operational levers to create financial results. What is a lever most owners wouldn't think to pull?
Oh gosh. A lot of the levers operationally are around maximizing efficiency and reducing the sales and delivery cycle timeline, right? That is the most immediately available lever for a lot of businesses. That it's highly dependent too on what their sort of work backlog is. I mean, if you're selling really long contracts, for example, that might be the only lever you have right now. Another area that you might appreciate is contract terms, You might not be able to go get third-party funding from a bank or from an investor, but you probably can make some edits to your contract terms that make them more agreeable to you. Obviously, pricing structure, redoing compensation for your team to make it more related to success. All of those things I would describe as operational, somewhat financial, but operational levers that can make a big difference. I mean, I've seen those kinds of levers work over time to drive margin exponentially higher. And the truth is that when you start pulling those levers, that does make this third-party funding more accessible to you because you have the results to justify it, right? Because a lot of people, they're waiting too late. They don't anticipate the problems that they're having with their cash and their liquidity. And then they are stuck, right? And they spend a lot of time, sometimes months and months, going around and around trying to get loans from this place or that place. And it's like, well, if you had just spent that time really digging in on your operational efficiency, you would be better positioned. So.
Sure. What is the number one decision business owners make with bad or incomplete financial data and didn't realize that they made that decision?
I think it's mostly around being really aggressive on investing in the front end of the business without thinking it all the way through. That is, I think, really a huge risk to businesses that they underestimate. It's like sales cures all ills. Sometimes it does. And other times it does not. And it's particularly damaging if you're out there making a lot of sales and you don't really understand what the margin is on those sales. And then you go to find out that you've sold unprofitable, whatever you're selling.
Right.
deals, but also there's a lot of parts about rapidly increasing sales that are difficult to manage, right, from a cash flow standpoint. And that's what really gets people stressed out is when that happens. I mean, what are you going to do about it, right? You have to deliver all
Right.
that work.
You said that, many business owners built their business on instinct and hustle, and you actually liken it to how you built your career. What's the first financial blind spot they probably have?
The first financial blind
Or
spot
just,
that they
or
have.
even just what financial blind spot they may have and they built it on instinct and hustle. Because the instinct
They
and hustle
are
gets you
not.
so far, but at some point you need to change, transform.
I would say it is making decisions around pricing and comp on their team based on some like nonsensical, industry assumption, web research, and just going with that, right? That is not something that they should do. I mean, you can see almost immediate improvement in financial performance if you are just less impulsive about that, right? When you hire somebody and you give them a bad compensation package, I mean, it might be great for them, to be clear. It is really hard to walk that back later. You're at risk of losing really high performing members of your team. That's a big problem. That's a big problem in a sale process too. Nobody wants to go buy a company that's, really hinging on some critical person that has a comp structure that is sort of an uncontrollable expense. And you see it a lot where the business is just not making money. And it is because that a lot of times it's because of that. I mean, sometimes there's market pressure. Obviously, there's always market pressure, but sometimes there's more market pressure in certain industries that they just don't have a lot of control over their price point or they don't have a lot of control over their contract terms. And I would say in those environments, these kinds of compensation decisions are that much more important and making choices about, maybe how you're sourcing whatever it is that you're reselling. Things like that are that much more important in environments where you don't have control over pricing structure.
Okay, I have a good one for you.
Okay.
What's one question every business owner should be able to answer about their company right now, and they can't?
How much is their gross margin? I'd be very surprised how many companies we look at their financials and they have 100% gross margin and they do not know. They don't know their overall gross margin, and they certainly do not know their gross margin by, type of service or customer industry or whatever other segment might be applicable to them. They do not know their gross margin. They might not even know their unit economics. But if they do think that they know their unit economics and they don't know their gross margin, then they really cannot pressure test their unit economics assumptions, right? For all they know, there could be extra waste or inefficiencies that are actually making it appear like they are much more well-positioned from a gross margin perspective than they actually are. Very common.
So if I'm a company that's I've been around for a little bit, I'm growing, and I've kind of moved past. Well, I have a bookkeeper, right? And when is the time for me to engage a company like yours, a fractional CFO?
So we don't do bookkeeping at all, right? So we do have to have adequate financial recording.
That's right. That's why I said I had a bookkeeper. I said I have a bookkeeper. I knew you were going to say that.
Sometimes we still have to fix that by getting a better person in.
That's true.
Sadly, that happens, but it's really more about, it's not about, revenue size. It's not about profit value. What it's about is who this business owner is and what they want from their future, right? If they have goals that they want to achieve, particularly if they've been stagnating for years, then, I would say now is probably the time, right? Because if they're comfortable with where they are and they don't really want to make any changes, they should not hire us, right? Should not. We have, different price points. So we're pretty accessible, I think, to a lot of different sizes of businesses. But, if they feel like they don't understand how their operational choices day to day make or break their financial performance, then they have a problem. And if they don't understand that, then they cannot make good growth decisions. And that is going to harm their ability to achieve their goals, right? Certainly, if they are 5 years or less from exit, they absolutely need to get somebody in there to take a look at their recording and just make sure that it is going to be good enough to get through a diligence process. Because very often people think they have pretty good financial recording and they don't. It's very common for business owners to tell us that they are on accrual basis when they're not. It's very common for us to have really see really, really wildly swinging margins month over month. It's more common than you would think that business owners do not know how profitable they are until the end of the year when their taxes get filed. There's just no hope for you to make an exit if you're in that situation. So certainly if you're 5 years out, I think probably now is the time to have someone take a look. Might be fine. But we're not really exclusively working with people that are imminently trying to exit their business. We're just working with people that they have goals, they want to grow better. And sometimes that's because they have personal financial goals that they want to hit. Other times it's because they have a lot of passion for what it is that they do and they just know that it's going to be a big impact. A lot of times it's both, right?
Right.
So,
Like you said something, Nicole, very important, right? And just want to kind of go back to it. And this is growing on purpose versus growing by accident. There's a lot of companies that, they have certain pillars in their business that's really very good, like say the marketing,
yeah,
say the business development, and
yeah,
they get the business in the door. Doesn't necessarily mean
yeah,
the business is profitable because you get into the pricing part. But so they're
right,
busy. It's busy and they're hiring people and they're hiring people. And they can continue to go and continue to go. And then something happens, whether it's a lawsuit, whether unfortunately something happens to someone in management, or maybe a contract is lost that was unexpected. And
right.
at that point, they really see the weakness of the underbelly, as we say, right?
Yeah.
So, I push back on you, Nicole, when you said, and I said, when someone reach out to someone like yourself, and you begin with when they feel. And I'm really funny because, you're a numbers person, you're talking about feelings.
Mm-hmm.
And usually it's a feel, let's just say, I'm a golf guy, and the feel and the real, right? And what you feel is not necessarily real.
Yep.
And that's kind of why, what I advise is don't go by what you're feeling, because,
Mm-hmm.
money's coming through the door. You might feel good, but, you're one event away because the way you operate in the business from,
Yeah.
disaster. So I just think that it's fiscal responsibility
Well,
to
I agree. Everybody
run
should
a
call us.
company.
Literally everyone should call us, right?
To call you or have a CFO, or a competent CFO or fractional CFO uh,
Yeah.
in their business, so they can make these more informed decisions about how they want to move forward and how they operate today.
True.
So you can
Yeah.
try to avoid, those sometimes inevitable downturns in business, or sometimes inevitable things that occur. That sort of end up doesn't destroy your business or have you lose all your hair. I didn't lose my hair because of business. So, but you know what I'm saying?
Uh-huh. I do.
So, we reached this point and it's just been a wonderful conversation. And,
Mhm.
I usually ask my guests if you can give a business owner, piece of advice. What would that be, Nicole?
Don't let things fester. Okay. If you have this experience where every business owner is facing hurdles. There is not one person that owns a business that does not have a hurdle, right? But what you see is people getting too busy and they're kicking the can down the road
Mm,
forever,
mm,
right? Now, sometimes that's things like you're talking about, it could be compliance. It could be, customer concentration that's really high. That's a high risk situation. It could be that you're just having a really hard time keeping your people on board. It could be that, like you're saying, they feel like they are very busy and they're working so hard. And at the end of the day, they don't seem to be making headway financially, right? They're
mhm.
still stressed about payroll every week. Or maybe they're not, but they're not getting the results that they think they should get. And sadly, we'll see people stay in that state for years. And every single day that you allow that to continue, it is making your business perform worse, right?
Yeah.
Every single year that you don't grow at a certain rate, you're really losing, and the last thing you want is for people to make impulsive choices. Something about their business frustrates them. So they impulsively decide to change it or get rid of it or do whatever. And then the next thing you know, it's just happening again with something else. You can't keep doing
Yeah.
that over and over
Yeah.
again, right? And
Yeah.
sometimes that's really damaging because then they say, oh God, I really do want to do this other thing. And it's like, well, now you can't, right? Sometimes they're making like corporate legal choices that are really probably not advisable because of just a whim. You know what I mean? It's kind of interesting to see the kinds of things that they'll do. They'll make really bad choices that they don't realize are important, right?
Right.
I mean,
Right.
yeah. So
Right.
I would say just don't let things fester at all. I mean, get
Sure.
proactive on your business.
Well, thank you so much. It was great to
Yeah,
learn a little bit more about you. And
always
hopefully my
happy.
audience got a lot of knowledge related to the financial aspects of their business and really understanding how a fractional CEO can help them have a much more profitable business. And now, and the one term we all should be going back Googling or putting on AI is gross margin. What is my gross margin? Let's get in my financials. Let me reach out to my bookkeeper to figure out my gross margin.
I mean, it's been shocking to me. That's been, I think, one of the most shocking things to me after I started this business is how many people really do not know that information. And I mean, if you don't know that, you need to know how you're performing. So you need to have a goal and you need to know if you're not hitting it, why not? You need to
Sure.
diagnose it. So yeah, gross margin, number one thing to know.
Thank you for listening to this episode of Kicking Ass and Taking Names, a business owner empowerment podcast. Remember, information is only as good as its application. So start making transformational changes to your business and life today. If you like the show, follow wherever you get your podcast. And if you are enjoying this on YouTube, hit that subscribe button and leave a comment letting us know what you think and what you want me to talk about in a future episode. If your business needs a legal partner, contact us at www.glgdc.com. Thanks for listening, and I will see you next time.